Thank you, Kira, for that introduction. Pretty young face, right? I've decided I'm not growing any older unless you want to look at me in real life. Okay. I'm not here this morning to talk you into the ground. I'm also not here this morning to talk you up into the stars. We are in a very strange space. Haven't been there for, I think, a long, long time. The system has been grinding down for about 4 years now. We are definitely underperforming. On the one hand, on the other hand, there are supportive factors that essentially keeping us adrift, going sideways. If that sounds like no man's land, then by all means, as I say, you have to go far back in time to come across a similar kind of situation. It's got everything to do with what is happening internationally, in the manner in which it gives us headwinds. It is especially the decline in commodity prices since the peak in 2011, which is a matter of giving us less income as a nation. And you certainly will feel that, even though the actual effects are difficult to trace. But the rest of the explanation is very much homegrown. Some of it is on the supply side of the economy, things that are specifically not working or working well. I'm thinking of the cap on electricity. I'm thinking of the labor market in the manner that labor relations have deteriorated. And we have massive strikes that impact on output. And not least the manner in which the government is behaving in terms of its regulatory demands that it is making. All that adds up to a situation where we find especially business taking a step back. It has been doing that for the last 5 years, ever since we entered recession in late 2008. And what we find is that while traditionally, as you come out of recession, business confidence should pick up, and therefore generally the economy should start to reflect that, this particular cycle is most unusual. Business confidence has never properly recovered. For me, the one single statistic, if I have to show one to foreigners, is the RMB-BER Business Confidence Index. It is a very predictable cyclical indicator. Over 30, 40 years, we see it going up and down along with the economy. The difference is that after the recession of 2008, 2009, this particular index only minimally picked up and then stayed essentially in negative territory throughout. And we then ultimately see this reflected in the actual economic statistics. Economic growth came back only for about 12 to 18 months and then started to lose momentum. And that loss of momentum is essentially due to a lack of confidence on the business side, and if business is lacking confidence, it becomes defensive. It essentially is not investing what it would otherwise do. It is not creating jobs as it otherwise would do. And in the process, you're embedding stagnation. There is one more factor. Then more than ever before in our history, business essentially has a escape valve. It is essentially has found other countries where it can invest, where it makes good returns, and from a purely business point of view, such diversification makes an awful lot of sense. But what you then ultimately are doing, you are putting your domestic operations on what I call a care and maintenance basis. That does not mean that we are at zero. We are essentially, I think, maintaining about a 2% growth rate once you come out of the strikes of the early part of the year. But 2% is well below what we're capable of. The average longer term is 3.5%. And of course, we are certainly not outperforming in terms of the National Development Plan, which puts us a target of 5% growth. In so many words, this decade is starting to shape like the 1980s, where for different reasons, we also created difficult circumstances for ourselves, where the economy basically throttled back to about a 1.5% growth rate, and kept it going for about 8 years before finally the problems were not resolved but addressed in such a manner that confidence was at least partially restored, and we saw the economic performance coming back with it. At this point in time, we're waiting for that happy moment. Everything suggests for now that the condition that we're experiencing will continue for some years, both on the supply side, in terms of, for example, the electricity constraint, the condition of labor relations, the manner in which the regulatory burdens of the government are imposed. These are things that don't seem to be going to change overnight, in addition to which the global condition is not likely to give us any windfalls anytime soon. For that, you have to move into the next decade, once the world is in a more normal phase. And even then, I think the next windfall in South Africa's case, as in so many other countries, is probably going to be of a domestic nature, and I'm specifically looking at the energy field. But by that time, you will be a lot older than what you're now, and that picture will be that much more irrelevant compared to this morning. And it helped that I had a haircut yesterday, so there's even some resemblance there. So essentially, I'm sketching you a stagnation environment, but in a stagnation environment that has a relatively low growth rate, an employment situation, at least in the formal sector, that is not changing too much. And the big question that we've all faced, okay, you're sketching us a disappointing growth environment, but how much financial volatility can we expect? And there we have the promise from the Reserve Bank that you are in a rising interest rate cycle, guaranteed. This has got very little to do with the actual performance of the domestic economy, obviously. We are underperforming, we have spare resources, we are far from complete in terms of this business cycle. There are no strains at the production level where you would want to cut back demand for that reason. And yet there are other reasons where you can see why they would want to raise rates. On the one hand, you may identify that spending growth in the economy has outperformed production growth in the economy. And the consequence of that is that we have a 200 billion rand a year habit that we cannot afford. We are importing 200 billion a year more than what we're exporting, and we have to borrow the difference. Now, as long as there's someone to provide us with the funding at a reasonable rate, that is fine, but that is the question. We're coming out of a period where such funding was very easily available at very, very generous terms, but we are moving back into a world where more normal conditions are going to apply. And moving into that world, how much volatility are we going to experience, financial volatility, and how is that going to affect us? The Reserve Bank is very much aware that we are exposed, which is another word for saying fragile. And if you felt a little fragile this morning and not inclined to answer questions, that's exactly what the country feels like. It doesn't want to answer any questions, any imposing questions from foreigners who have a few very penetrating things to ask. Aside of that, the Reserve Bank knows us only too well. Both our businesses and our organized labor have a history of demanding inflation compensation. And otherwise, if you put up my costs, I'm going to insist that I can put up my prices. Because the one thing that is not going to suffer is A, my lifestyle, and B, my shareholders. Is that South African or is that not South African? Unlike the United States, where at this point in time you've got absolutely minimal negotiation power, absolutely minimum pricing power, as much as businesses, as individuals in the labor market, and where for that reason alone, inflation is near the 0 to 1% level, and in fact dips below zero in any month in which the commodity prices really go negative, as happened this past month with food and energy. Given our imperfect markets, given our inclination to demand inflation compensation, given the financial risks that we're running externally of suddenly being shocked by these adjustments that are taking place externally, which will of course hit the currency and will therefore lead to higher imported inflation, the Reserve Bank is extremely aware and cautious and careful about any developments that may cause such a process to get underway and would then cause what it would call a wage price spiral in the worst of circumstances. And in a kind of preemptive stance, perhaps hope against hope, that it somehow can prevent too much external volatility as the world adjusts, it wants to raise our interest rates very smoothly hopefully not disrupting the domestic economy too much, but preemptively ahead of what is going to happen internationally. Now, despite all appearances, I've never surfed in my life, except the internet. And the anecdote that comes to mind is the surfer who is waiting for that wave and then stay ahead of the wave as the head builds in order to ride this thing all the way to the beach. In other words, do not get caught by the wave building up and ultimately drowning you. And that is the best anecdote I can come up with. So can I raise my interest rates ahead of the Americans? They use the word front running. Sufficiently that as the markets start to adjust, they feel that the premiums that we're offering them remain realistic, and they won't look too much at our weaknesses, our fragility, our balance of payments deficit specifically, and will continue to fund us for the simple reason that we seem to get it. We seem to be repricing ourselves ahead of the general wave, and for that reason, money may want to come and support us. I won't say that it's on a hope and a prayer, on the one hand. On the other hand, I have to observe that the processes that are being unleashed internationally are on a scale unprecedented, really. The kind of movements that they're contemplating have not really been tried before, although there are other comparisons. And for that reason, there has to be substantial uncertainty as to whether the markets remain benign and smooth in their working compared to developing shock-like characteristics, which would then be registered in the currency, in our currency, in the rand, and which would likely feed through to the inflation rate. And as a secondary feature, then the Reserve Bank always will stand ready that when it gets out of control, they use the word disorderly, it is prepared to hit it on the head. And some of you seem to be old enough to know what it is like to be hit on the head by the Reserve Bank. I can think of 1998. I can think of 1980, was it 85 or 84 rather? Now, of course, that started from different levels. This time, the prime rate started from, remind me, was it 625 or 825? Yeah, sorry, I get confused in the process. But the point is, we are not starting from an 18% level. So over the intervening 10 to 20 years, the interest rates have come substantially down. So we're starting from a base, which you don't really recognize if you look back over the past generation. But the question still has to be asked, if you get into a shock development, what kind of interest rate development would you get locally? Where do you end up and over what time period? Now, I'm not here this morning as the scaremonger, but you are in property. You are geared, you are leveraged, presumably, and therefore you have to be realistic about the interest rate cycle and what that ultimately does. The way the markets are discounting at this point in time, to the extent that they go out far enough in time, and the way people are discounting things, they remain very modest in their expectations, which is not actually warranted by our DNA, given the history of things, and which potentially is not warranted by the enormity of the processes playing out internationally. Put differently, you need to be an optimist to essentially stick with, say, a 2% move in prime over a 2 to 3 year period, compared to saying, no, it will be more. Now, funny enough, in that respect, I'm an optimist, and have been for some time, in that I'm saying that despite the enormity of what is playing out internationally, there are some redeeming features. One is that after a massive financial dislocation overseas, which is what happened in the United States and specifically England in 2007, 2008, the patient overseas has been badly affected, was in a bad condition, has had good treatment, but now takes a very long time recovering. And the very nature of what the patient experienced and the very nature of the treatment that he was given would nearly guarantee that the play out is going to be long, steady, slow, and not necessarily accompanied by shocks, provided the policymakers continue to call this right. And there is not another source of destabilization that we are not aware of. There was one in 2009, 2010 in Europe, but happily that one was too addressed in a similar manner. You can still argue, as some people do, there is one out there lurking in China, but I suspect it is of a later nature compared to it actually being lowered on us at this point in time. Long story short, my sense is of a long runway and a fairly smooth liftoff in the plane. And under those circumstances, minimal ripples. Now, you wouldn't say that by the experience we had last year, when the Federal Reserve Chairman started to mutter in public that, you know, guys, it is about time that we started talking about how we're going to dial this thing back, that the markets basically took off in a hurry, in a stampede, if you wish. They gave it a name. They called it a tantrum. And if you had small children in your life, you will all know about tantrums, presumably. Although road rage also comes to mind. Same origin, frankly, just 50 years difference. That had everything to do, I think, with uncertainty in global markets as to actually what it meant. In other words, from a cold start, having to adjust to something you don't understand, well, don't ask questions, panic first and ask questions later. Enormous divergence of opinion, specifically also because there are an awful lot of people with a different view as to what is really playing and what the consequences are. I've given you the Bruggermans view, but there are as many views out there worldwide as there are people as to what the real nature of these crises and the policy treatment and the ultimate play-out is going to be. There's only one way of testing that, and it is going through it. What the markets discovered last year was that they were wrong. There was no need to stampede. The play-out remained very benign. The Federal Reserve was reading this right, and it was time to calm down. It took only 9 months, but the markets ultimately, by the beginning of this year, came back into line with the Federal Reserve indications that this remains under control. This has been the case for the last 6 months, for which reason happiness has reigned in global markets, on top of which Draghi came to the party in the manner in which he made announcements over the last couple of weeks in Europe. But now we are in a new phase where specifically the American adjustment, the first phase of the American adjustment is coming to an end. This business of buying fewer and fewer bonds until you ultimately come to a standstill in terms of the balance sheet of the Federal Reserve. And you start focusing on raising interest rates to more normal levels, from 0 to now estimated at about 3.75 by the end of 2017, a mere 2.5, 3 years from now. And as this new phase comes into focus, we again have many people around the world, if you give them only that small an opportunity, they will want to panic because they have diverging views as to what it all means. And yet, as we saw last night, a simple word or two in the right ear, at the right time, with a couple of 100,000 people, if not million, watching, can actually work magic. And the markets have again bought into the message that this will remain benign, the runway looks good, the performance is as predicted, there are some divergences in that view, but we are facing all this with our eyes wide open. I'm reminded of leaving home into a Cape gathering storm where you can see the rain clouds gathering and you know there's going to be rain ahead, but you also know you will get to the other side of wherever you're going, if you're lucky enough. And on that basis then, the markets at this moment in time are not into a tantrum, although they are repositioning for what is taking place. My sympathy goes out to the Reserve Bank in that every few weeks they have to make one of these decisions and they try to position themselves for the adjustments that are coming without hurting us too much. At the same time, they want to take out enough insurance that whatever is going to happen in the markets will also remain relatively smooth and benign. Clearly, the words that I'm choosing and the manner that I'm describing it, you are not in charge of the process will just play out, and you must hope and pray that it will proceed in the manner that is being sketched here, and that you won't have to become too draconian. That gives you an indication of risk that things work out differently from what you were expecting. The Reserve Bank is likely to remain as incremental as what the Federal Reserve will be, in their case a quarter per meeting, starting sometime in the middle of next year. But bearing in mind that they're not the only player in town, Draghi in Europe is going the other way. He will become more supportive, and you're getting some kind of neutralization taking place with the Federal Reserve doing this, the Europe doing that, and it is not the same hit, it is not the same impact on markets, which is all in our favor. This is a grand case to suggest that the more modest interest rate lifting that will take place in this country over the next 2 to 3 years will also remain modest. In other words, if you're just over 9% prime now, you may peak at a level of 11 to 12% in the course of 2017, 2018. But I think I've said enough for all of you to be aware that it depends on an awful lot of things internationally. The actual behavior of the main economy, the United States, the behavior of the policymakers in doing it the right way, and thirdly, the interpretation that markets place on both of these things, and whether markets have a way of creating their own stories and then having to come back, but in the process causing an awful lot of volatility. If I'm wrong, you can double the number. In other words, instead of a 2% increase, you can talk about a 4% increase. And 4% historically over the last 30 years is a more representative interest rate cycle increase, but of a base this time, which only starts in the, 8% level, 8 to 9%, compared to historically on a higher base. So percentage-wise, if this becomes volatile, you face quite an adjustment in your interest rate burden. The outlook for the currency is of a similar nature. It will continue to go well until clearly it no longer goes well. And that is also part of our DNA. So you have to allow in your mind that given who and what we are traditionally, and given the fragility that we have allowed to creep into our system, and given the enormity of the adjustments playing out internationally, where we're now in a rising dollar phase, the remainder of the world tends to go the other way in terms of the currencies. And the question is, will we stay in line with our peers, or will we make a bigger currency adjustment than them? And to what extent is it neutralized by the actions of the Reserve Bank in terms of the interest rate regime? There again, you can take the view that the currency adjustment will remain smooth and orderly, these are the key words, and that you basically add a rand a year to your system. So if this year is if this year was 10 to 11, then is next year 11 to 12, is 2016 12 to 13, and the year after 13 to 14. Bearing in mind that at least half to just over half of that is the inflation differential coming through. So shock value is actually very, very limited. Compared to saying, no baby, out there somewhere there's a 98 in your world. And then you're going to see a shock-like development to the currency, and you're likely to see a shock-like development to interest rates. And we are not yet clairvoyant, unfortunately, although I understand they're working on that, that we can actually foresee the nature of shocks and predict that correctly. But you will agree to me that as we do not actually know what's going to happen tomorrow morning, foreseeing these shocks over a 3 to 4 year period while the world is going through this adjustment is really extremely difficult. We can limit ourselves to basically pointing out the obvious. We are fragile, we are exposed, the processes are enormous, and hopefully it will work out benignly. Is all of that acceptable? The country could perform an awful lot better, but as you know, we have a very complex history, and apparently it takes a lot of time to get to grips with that. And a human lifetime may not be enough, I'm finding out. Under these circumstances, for me, the decade is an uninteresting one, like the 1980s. It is one of underperformance, rising imbalances, a lot of confrontation, and you're inclined to switch off all news media if you only see pictures out of the parliament. Other than that, in a financial sense, our assets are well diversified. I'm thinking of the stock market. I wrote an article about 2 months ago where essentially if you have a portfolio based on the stock market, about 75% of the earnings flow is international and therefore rand hedged. So there's a good reason why the stock market has continued to outperform, despite the fact us being very unimpressive domestically in the manner that the economy has been performing. At the same time, when it comes to things like bonds, we are in a rising interest rate environment. So under these circumstances, that is a market that now is going to encounter further headwind. But that is all in a very stylized cyclical play out compared to saying that there's a shock in your future. And when it comes to shocks, as I've indicated, we will have to wait and see. Personally, so far, so good, as the guy said as he passed the third window on the way down. It has been quite remarkable, the extent of the 2008 hit and how the Americans picked it up, unlike what happened in 1929. And then the hit in 2009-2010 in Europe, where especially the British financial media predicted on a daily basis that Europe was going to implode. And now, as of this morning, it seems to be the United Kingdom that is going to implode, unless they get very lucky, in terms of the Scottish referendum vote. I mean, life is funny, isn't it? So the world has adjusted remarkably to very big historic crisis moments, and the play out may just remain of that nature. But as I said, there are an awful lot of people worldwide that question that, second guess that, and to keep the herd together, if you think Scottish Border Collies, you need a lot of Scottish Border Collies to keep that lot together. And yet it is one old woman in Washington, and it is one interesting looking guy in Frankfurt, who between the two of them are doing the herding by just whispering here and making a comment there and keeping everything knotted. So far, so good. In terms of the property picture generally, you're driving into a storm. You're doing that after 5 unimpressive years of recovery. I'm thinking building trade residential. Non-residential has been much better, and yet with an underperforming economy. People obviously found new ways of doing things, but you kind of wonder about the sustainability of that given the performance of the economy. But now we face we are already this year in a rising interest rate cycle. It has started very small baby steps. It has been a smooth ride so far, but we have to allow for the fact that the tide will rise. Hopefully it will not rise in shock fashion. Hopefully it will not rise excessively, as 98 did and as 1984 did. For those of you who can't remember, that was prime 25. But still one has to bear in mind that the picture is changing and the system will have to adjust to that. So on that basis alone, I would suggest that the next 2 to 4 years are going to be somewhat challenging. And it is not going to be the smooth ride that we should have had in terms of a business cycle that is far from complete, and it has way longer to run. And it is these international conditions, it is our interest rates that have to adjust to that. And ultimately it is the policy mistakes we're making domestically which makes life so difficult. I've spent about half an hour talking. Traditionally, there are questions at venues like this, so we have a few minutes left for any questions you may have on anything that I've said, or anything else that I haven't covered but it has your interest. And Aaron, are you happy that I take some questions?
Sure. What I'd like to do is actually have you on a panel a bit later, for people gather their thoughts, and then we can address you like that, if that's okay.
Your call.
Unless there's something burning. And I didn't hear on one hand and on the other hand, 25 basis points.
No, they removed my one arm when I joined the bank 30 years ago. And that actually happened, in case you want to know, at the board meeting. Mr. Chairman, can we remove his left arm? At least I took my left arm, not my right arm. No questions? No comments. Okay.
Thank you.